Welcome to the Deep Dive. Today, we're zeroing in on a pretty critical update. It's from a major global economic player, the OECD.
That's the Organization for Economic Cooperation and Development. And our main source for this is a recent CNBC article. It really unpacks their latest economic forecasts.
Yeah, and our mission here is pretty straightforward. We want to understand what the OECD is actually projecting now for the U.S. and, globally.
And why? Why have these big forecasts shifted?
Exactly. And how specific things like trade policy seem to be playing, a much bigger role than maybe you'd think.
Right. And what really jumps out from this report isn't just the raw numbers.
Right.
It's the reasons the OECD is giving, quite explicitly, for revising things downward.
Reasons touching on tariffs, uncertainty.
And even surprisingly, connecting into things like inflation and maybe the potential impact of AI down the line, it's quite a mix.
Okay, so let's dive in. What did they find?
Well, the big headline, really, is a noticeable cut to their growth forecasts.
Right, not just a small adjustment. A significant revision.
Definitely. The OECD has lowered its expectations for the U.S. economy and the global one, too, quite substantially.
And looking just at the U.S., the change seems pretty sharp.
It is. They've brought the U.S. growth outlook down to 1.6% for this year, 2025.
Okay.
And looking ahead to 2026, it's 1.5%.
And just for context, where were they before?
Well, think back to March, just a few months ago. They were looking at 2.2% for the U.S. in 2025.
Wow, so dropping over half a percentage point in that short time.
Yeah, that's a significant recalibration of their outlook, a big shift.
And it's not just a U.S. story, you said? The global picture is also looking less rosy.
A bit less robust, yes. Global GDP growth, they now see it slowing from 3.3% in 2024 down to 2.9% for both 2025 and 2026.
Okay, and their earlier forecast?
It was a bit higher, 3.1% for this year, 3% for 2026. So smaller changes than the U.S. figure, maybe.
But still a downward trend globally.
Exactly. And the report makes an interesting point here.
What's that?
It notes this global slowdown seems, particularly pronounced in North America. So the U.S., Canada, Mexico.
Ah, okay.
While other major economies might see smaller tweaks, the OECD seems to be flagging this region as a key area driving the revised lower forecasts.
Which naturally brings us to the big question.
Yeah.
Why? Why cut these forecasts and why so quickly, especially for the U.S.?
And the OECD is unusually direct about the drivers here. They don't really mince words.
They really don't. The report points explicitly to several key things contributing to the downgrades.
High on that list, the effects of tariff policy.
Right, and elevated economic policy uncertainty.
That too. Plus a slowdown in net immigration and a smaller federal workforce are also mentioned.
And the language used by their chief economist, Alvaro Pereira, it sounded quite strong in the article.
It was. He's quoted saying that trade uncertainty and just general economic policy uncertainty have reached unprecedented levels.
Unprecedented levels.
Yeah.
That's powerful. And they're saying this isn't just a theoretical risk.
No, not at all. The report ties that uncertainty directly to impacts they're seeing now.
Like what?
Well, the OECD states that as a direct consequence of this heightened uncertainty, they're seeing both consumption and investment pulling back.
So people and businesses are spending less.
Apparently. And key activity indicators are also showing declines. It's not just future modeling.
Right. So the OECD believes this uncertainty is already having real, tangible effects on behavior right now.
Exactly. And when they feed that into their economic models,
the result is?
The result, in their view, is a future with less growth, less jobs, and more inflationary pressures.
Okay, more inflationary pressures. Now, that's interesting, especially how it ties back to one of those drivers you mentioned earlier, tariffs.
Yes, the link is made very clearly. The report explicitly states that, quote, higher trade costs, especially in countries raising tariffs, will also push up inflation.
So tariffs mean higher prices, essentially.
That's the argument. They do mention that maybe weaker commodity prices could offset some of that, but the causal link they draw between tariffs and rising prices is pretty clear.
And this seems to be creating a noticeable difference, then, in their inflation outlook for the U.S. compared to other big economies.
It really does. If you look at the G20 countries, the world's 20 largest economies as a group, their overall inflation forecast for 2025 has actually come down slightly to 3.6%.
Okay, down slightly for the G20, but for the U.S.?
It's gone the other way. The forecast has risen pretty significantly, actually, from 2.8% back in March up to 3.2% now for 2025.
Wow, that's quite a jump.
It is. And the OECD even suggests U.S. inflation could be, getting close to 4% by the end of 2025.
So this divergence U.S. inflation forecast going up while the G20 average trends down, that's a key finding.
Absolutely. And the report highlights it, linking that U.S. increase, at least partly, back to those same rising trade costs from tariffs.
Okay, so just to recap where we are. We got lower growth forecasts, explicitly linked by the OECD to uncertainty and tariffs.
Right.
And now we see rising inflation expectations, specifically in the U.S., also partly tied again to those same trade costs.
It really paints a picture of how these policy choices can ripple through the economy in multiple ways.
Yeah, it does. Which then kind of leads to a broader question, doesn't it, about the overall economic environment we need for, future prosperity.
Exactly.
Especially when we think about potential boosts from technology.
Exactly. And this is where the OECD chief economist brings in things like artificial intelligence. AI.
Right. The potential of AI and other tech advancements.
He talked about how these innovations, AI, robotics, quantum computing, they hold significant potential. They could really boost productivity.
A significant productivity revival, I think was the phrase used.
That's it. And he specifically pointed out that productivity has actually been quite strong in the United States recently.
Suggesting that trend might continue.
Possibly widen the gap even between the U.S. and other countries, partly because U.S. sectors might have higher exposure to AI, more potential upside there.
Okay, but here's the crucial link, right? The connection back to the earlier points.
This is the critical connection. While the potential for these AI-driven gains is real and exciting,
yes,
the OECD's chief economist links actually realizing that potential to specific economic conditions. It's not automatic.
What conditions?
He stated quite directly that if we are able to get trade agreements between countries, and if we are able to reduce uncertainty, we do believe that we might be on the cusp of something quite significant.
So unlocking the full benefits of AI and tech requires less uncertainty and fewer trade barriers.
That's the argument being made. That something quite significant, the full productivity leap, is contingent. It depends on lowering those trade barriers and reducing uncertainty.
The very things they argue are currently holding back growth and pushing up inflation in their analysis.
Precisely. It really underscores this complex interplay. Trade policy, economic stability, and our ability to actually capitalize on technological breakthroughs.
It's not just about goods crossing borders. It's about the underlying conditions needed for, well, future prosperity itself.
Yeah. So wrapping up our deep dive into the OECD's latest outlook based on that CNBC piece.
The picture is definitely one of revised expectations. Growth forecasts, both U.S. and global, are trending downwards.
And the OECD is pretty clear on the why, pointing primarily to tariffs and that elevated policy uncertainty as key drivers.
Right. And we also saw that notable difference in the inflation outlook.
Yeah, the U.S. forecast rising while the overall G20 average fell slightly.
A divergence the report connects, again, partly to those higher trade costs.
Then maybe the most forward-looking point, bringing in the potential for big productivity gains from tech like AI.
But with that crucial caveat from the chief economist.
Exactly. That unlocking this potential seems to rely on specific conditions. Lower trade barriers and reduced uncertainty.
This whole deep dive really highlights the far-reaching consequences of policy choices, doesn't it?
It really does. Things like tariffs or creating uncertainty, they don't just impact immediate growth or jobs.
They also hit prices and maybe even shape the fundamental environment we need to benefit from technological progress later on.
So what does this mean for you listening? The OECD's analysis, well, it strongly suggests that the path to future economic prosperity,
especially prosperity boosted by exciting things like AI,
seems to depend quite heavily on creating a certain kind of environment, stable, open.
So here's something to think about. Given the OECD's analysis, especially that point from the chief economist about needing lower trade barriers and less uncertainty to really unlock productivity gains from technology,
what does that suggest to you about the necessary conditions for future economic prosperity?
And maybe more personally, how might persistent uncertainty or these rising trade costs actually affect that potential pathway for the economy that, you navigate every single day? Something to consider.